everyone. Today on Market Makers, we have Shaily from Tata Mutual Fund. Shaily is head of products and has over 18 years of experience in the financial sector. In this discussion, we are going to simplify various jargons used in the investing world and also talk about Tata Mutual Fund's upcoming NFO, which is based on Nifty 200 Alpha 30 Index. Welcome, Shaily.
Thanks, Milan, and glad to be here.
Thank you. So, Shaily, what is this index, Nifty 200 Alpha 30, and how is it different from other indices? Could you please explain or elaborate on this in simple words?
So, alpha is one of the factors, and of course, as we go along, we will speak about what are factors. But right now, it's one of the factors which is applied on a universe representing the broader market. In this case, it is Nifty 200. What this index does is it identifies all the stocks which have created an excess return over the benchmark or over the broader market, and it gives more importance to stocks or companies which have generated a higher alpha per unit of risk. So this, in a nutshell, is what this index does. And Tata Nifty 200 Alpha 30 Index Fund is replicating or mirroring the Nifty 200 Alpha 30 Index.
And for a regular investor, what does alpha mean and why it is important to track or see alpha while investing?
Sure. So alpha is the excess return in very, very crude, raw parlance. It is excess return over the broader market or the benchmark. Now, what the methodology of calculating Jensen's alpha does, it removes for each stock there is an alpha calculated, a Jensen's alpha calculated, and while calculating the Jensen's alpha for each stock, there are two components which are kind of removed from the overall stock's return. The first component is the risk-free return, which is anyways available in the market for to anyone and everyone who goes and invests at, let's say, 6%, the T-bill rate or any government security rate which is available. And the other component is the return which this stock or any stock would naturally earn in the market because of its sensitivity to the market. So every stock carries a particular sensitivity to the broader market, which is known as the beta. So you adjust the stock's beta to the market's return, and you say that this stock carries in 1.2 or 1.3 beta, let's say. So if the market is given 10% return, 1.2% of 10, so 12 percent return any which ways is naturally supposed to be there to be given by this stock. Now this natural return, so one is a risk-free return, and the natural return which can be generated by the stock is also removed. And after removing these two components, whatever is the excess return which that stock has given, that's the true alpha. Now, alpha, it's one of the factors. For example, as you asked, why is this important? So you have various lens and characteristics to look at into the portfolio. For example, when you are assessing a hotel property, you would take the lens of, let's say, how good the food is, or how aesthetic the stay is, or how green the expanse is around the property, or what are the activities included in that. Or, for example, if you were to talk about a movie, you would talk about how good the star cast is, or how good the storyline has been, or whether the visual effects have been impressive and good. So these are various lenses that you are taking, characteristics that you are discussing the object with. So similarly, you could discuss a portfolio with various characteristics, and growth, value, size of the stock. These are various lenses that you take to look at a portfolio. Alpha or momentum are other two lenses. So in this case, we are talking about alpha. And if you see in the entire factor investing world, the alpha has been one of the top performers. High risk, high return strategy, of course it is, but it has been one of the high return yielding factor strategies. If you were to put all the factor strategies, in the same sheet. So why not capitalize on that?
Very well explained. So, Shaily, typically when we say passive investing is usually like following the index. So, how does this, new fund, which is Tata Nifty 200 Alpha 30 Index Fund, aim to provide both, the benefits or ease of passive investing plus aiming to beat the overall market?
Very well put, Milan. Yes, smart beta funds try. Their endeavor is to beat the market, broader market, and having said that, they do use passive rule or they do use rules to construct the portfolio. So yes, they sit somewhere in between active funds and passive investing. Smart beta is talked about from the active lens only because even active funds try to outperform the broader market and beat the market. Similarly, even smart beta funds try to beat the market. Actually, around 1960s, there were some models developed, and that time uh, there was only one way, defined for us what drives the stock's return and risk. If you were to think about this thing, that what drives a stock's return and risk, sometime back in around 1960s, the answer was that it's sensitivity to the broader market, which is beta, or the market exposure. That is something which drives the stock's return. And then as academicians and practitioners studied it further, they said, no, there are more ways in which you can explain a stock's return and risk. It could be the size of the company, it could be the whether it's a growth stock, or a valuation perspective. So it's a value stock, or is it a low volatile stock inherently, or is it a high dividend paying stock? So likewise, these six core factors were developed to explain what defines or what drives the risk and return of a stock. And as these factors developed, factor investing has now become more popular within passive investing currently. So it tries to beat the market, but yet it applies, each factor has their own parameters on the basis of which the stocks are selected, and also they have parameters on how the weights are allocated. So that ways it is passive in nature because there are rules around stock selection and weight allocation both.
How does this kind of rebalancing help the fund to stay on track?
Yeah, very important point to think about. Rebalancing is quarterly. It'll be quarterly rebalanced. However, there is a mechanism of buffering which comes in. So it's not that all the 30 stocks are moved out and a new set of 30 stocks comes in. It's not like that, because there could be some stocks which could be below 30th rank but still closer to the boundary. And if you just ignore that part and completely turn around the portfolio, then the turnover increases by leaps and bounds, and those same stocks go out at the border and then again come in after 2 quarters maybe. So too much of turnover, this could be a hindrance in replicating the portfolio. See, finally the index is constructed to replicate it and earn returns. So if while replication, this complete moving in and moving out causes a lot of transaction cost and turnover and churn, then there is no point replicating an index. So what the index constructor themselves have taken care of is that the top 15 stocks will be mandatorily be there. The alpha score of those top 15 stocks is high, that's why they're top 15, and those will mandatorily be included. And the other 15 stocks, which means 16th to 30th, if they are within 45th rank, they will continue to stay, they will not be moved out. Only if between 16th to 30th stock, the rank of those stocks in the next rebalancing run fall below 45th, then those stocks will move out. And we've also discussed with the index constructor, there are just 4 or 5 stocks, in this recent period since this thing was launched, the index was launched, that 4 or 5 stocks have been in currently that zone. But it's a trade-off between how much can you churn in and churn out, um, you know, and vis-a-vis saving on the transaction costs and making replicating the index easier, because finally you may never know if it's borderline cases again next 2 quarters or next quarter itself the stocks could come in. So
Okay.
why put them out now? Yes, yes.
Yeah. Shaily, when we were going through the NFO presentation, we saw the historical data. And as per the data, during certain good years in the overall market, this fund outperforms, this index rather outperforms. However, on negative years, during negative years, there is significant downside in the index. So how should the investor view the risk reward ratio of this particular fund?
So you are right. We've also seen the live data and the back-tested data. Whenever there have been linear bull months or periods where it's a linearly upward bull market, this strategy Alpha 30 tends to do very well, much beyond the broader market returns for sure. During bear markets, also this strategy is able to identify certain stocks or parts of the market which would still be performing. Yes, but it could match up to the bear market levels of the broader market. Also, when there is a linearly upward market with a lot of volatility, then also this tends to outperform the broader market, but maybe the outperformance might not be that stark as it would be in a very linearly upward bull market. So this, just to summarize, this strategy would work very well in a linearly upward bull market, would done reasonably well still over and above the broader market when the bull market comes in with a lot of choppiness or volatility. And in the bear market also, it is able to identify those parts of the market which are still doing well, because in that bear market it's not easy to do so. Also, 5% cap on the stock. Each per stock, there's a 5% cap. That helps in going and searching for alpha stocks in all sectors and all areas of the market. And then it helps to the portfolio to become a lot more diversified. So the idea is, the starting point of thinking is not that this should be a diversified portfolio. The starting point of the strategy is to think that, where does alpha sit? Where is alpha currently sitting? Let's go and find out those. And while you're doing those, by putting a stock cap of 5%, this strategy is able to scan more areas and get in more sectors into its net. That's the idea of being diversified.
Is it fair to say that a stock where currently you're seeing the alpha may continue for few more months or some period at least?
So this strategy takes last alpha basis last 1 year price. Uh, but yeah, the way the portfolio is, as I said, the starting point is where does the alpha sit. So that keeps constructing the portfolio. However, the incidental part, which is the market cap exposures, or large cap, mid cap, small cap, or the sector exposures, they could be very dynamic. Even if after that buffering mechanism, which we just spoke about, is taken into consideration, even after that, the exposures are quite dynamic. The market cap exposures as well as the sector exposures, because finally objective of this strategy is to identify where is the excess return in the market sitting, and go and identify that.
Got it. And at this juncture of the market, where would this fund sit in an investor's portfolio? Is it for long-term growth or for short-term opportunities?
So, this fund could be part of the passive portfolio, and within passive portfolio, the factor investing. Of course, the volatility or standard deviation of this strategy is higher than the broader market. If the broader market, let's say Nifty 200 is about 18, 19, then this would a standard deviation, 3 year standard deviation, let's say it's about 18, 19%. Then for this alpha 30 would be about 20 to 21%. So definitely it's higher. It's a high risk, high reward factor strategy, which is there. However, the texture of bull markets could keep changing. So you could have, some bull markets which are very, very linear, some which are a little choppy. So this alpha 30 could sit as part of the passive investing and factor strategy, which could be around 15-20% of a client's portfolio. If factor investing is overall 15-20% of the client's portfolio, alpha could be one of the top three factors, because as I said, in India, if you put down all the factor strategies, from the return perspective, down on a sheet, then alpha definitely comes in the top three and top five. So there are various versions of alpha, but alpha 30 is definitely there in the top three. Looking at the 15-year rolling return data that we saw, 15 years till 31st July 2024. So that's a good enough period. So if that's the case, this strategy could be a part of the overall portfolio and the passive portfolio, and sitting under the one of the 2-3 factor strategies that the client would be willing to take.
Thank you, Shaily. Thank you for taking our time for this discussion, and all the best for the NFO.
Thank you so much, Milan. It's always a pleasure to be speaking with you, and through you to the entire Upstox investors and teams. Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.